This is the setup right now that's going to lead to much higher gold prices.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pains.
That's going to be bonkers.
Okay, everybody, welcome to another episode of Talking Trades with me, Kevin Wadsworth, and my friend and colleague there, Patrick Karim. We are talking today about low-risk entries in precious metals, low-risk entries in gold, and how to spot them, particularly if you're trading the precious metals market. Over to you, Pat.
Guys, okay, first up, there's a difference between stackers, investors, traders. I'll just give you a little preface. We know, like, we've had charts for gold hundreds of years where the gold price chart tracks inversely the purchasing power. So if purchasing power of the US dollar goes down, gold goes upwards. Like, that's over very long periods of time. That's what happens. We all know that a gold ounce pretty much keeps your purchasing power, could buy the same amount of goods that it did 50 years ago, 100 years ago than it can today. But there are cycles within that where where gold is in a bull era, bull market, goes up in its price chart, trying to price in the next phase of a destruction of purchasing power. And there's some phases where it's like human emotions, right? It overpriced the potential destruction of purchasing power that was incoming. It was a blow off top, right? The speculators came in and they made the price go higher than it should have. And then there's some type of reversion to mean that happens, right? The price of gold goes down. So stackers, they don't care, right? They think in ounces, but a trader, a swing trader, a position trader, even an investor, somebody who wants to hold 5, 6, 10 years, it could be kind of important, right? You want to understand where you're entering gold in its cycle. Are you in its blow off top phase and it's about to do a good correction, go sideways? Is the bull market over? That's where the charts come in, and they really help you see clearly how you could do that, right? Because sometimes you could just, if gold's about to enter a correction, you just you could exit, wait on the sidelines, and then you could buy some more gold when the correction ends. Or some people, they just want to stick it out and they say, okay, I'm ready for that correction. I'm gonna hold it out. But you got to remember always, these corrections, they could end up being, the market top, right? You'll know in hindsight, oh, finally, well, that correction just faltered. And now I'm in a bear market, right? So you always got to think about, okay, there's a correction that's starting. How do I identify it? And I'll show you the charts, guys. How do I identify a correction that starts? And what do I want to do? Do I just want to exit and just get back in a little later, or go through it? You have to decide that, preferably before all this happens, or else it'll just be your emotions guiding you, and that's could get you in a whole bunch of trouble, right? It's like when these people, they start by being traders. Oh, I'm just going to trade gold. Some people, sometimes they enter trades and they say, I'm just going to trade gold. I won't be I don't want to be like a stacker. But then after that, because they hung around during the correction, now the correction was 6 months, 1 year, 2 years. And then finally, I don't want to trade it. I'm in it for the long haul, right? You could do that, but it kind of hurts your emotional capacities when you know that essentially you didn't respect your own game plan, right? It hurts. You don't want to do that. You want to respect your game plan. So here I'll show you the evidence, and depending on your game plan, you could decide what you want to do with this information. So here essentially you have gold, guys, monthly chart, price in US dollars. Here you have that nice base here, the bear market, after that huge run it had in the 2000s all the way 2012, it went sideways. And then here you had a breakout, a beautiful, like 1 point, 2 points, 3 points, 4 points, like a beautiful breakout in June of 2019. And for me, that's practically, if somebody asks me when the bull market started for gold, that was it. Out of the cloud, above a 3-year moving average. The distance, guys, the bottom pane is kind of important there. This is a distance from that red line, the distance from the 3-year moving average, coiled in tight, exploding away. Because look, of course, in hindsight, like you say, this is a generational entry, but if ever you had a chance of having this type of once in a lifetime generational entry into something, they look like that. Doesn't mean that it has to go up. Sometimes they could fail these. But if you had a chance, if you had to bet on something at any given moment, that was it. So gold ran up, and look what happened. The distance from moving average, it outsped the moving average. And this is great. You always want to be where the capital's going in, outpacing the moving average. And after that, when it got stretched, guys, here I have a neckline where you see where it was so stretched from the moving averages, the price actually went sideways, consolidated. That's a 2008 GFC, consolidated. And here, blow off top, then consolidated. But guess what? That consolidation, just like I mentioned, it happened to be the last one, right? So you never know if these consolidations will be the last one, or they could be, right? So here's the move, another 2-year consolidation as the distance from moving average resets. And then after that, look, beautiful explosion. These are the low risk entries, guys, right here. Low risk entry. Explosion, measured move, target reached. And that is where we are today. And look how stretched we are. So right now, you guys should be doing the math. Okay, well, I'm on the sidelines. Now I'm starting to hear on the news that gold pricing in destruction of purchasing power. I'm hearing in the news gold's pricing in it's a safe haven, whatever narrative you want. But look at the chart. Objectively, that thing has lost momentum here, retested, super stretched. There's just no low risk entries right now for gold. There hasn't been for a while, right? It's been so stretched from moving average. There's no low risk entry if you're already on the sideline. If you entered here on these generational or these lower risk entry, right? Even the June one from 2019 or this one here from late 2023, you're in the profits. You've reached a classical TA measured move. You're in the FOMO selling into strength profit taking zone. Taking any type of profits here is fine. It's fine. If you're a trader, the moves are reached. That's when often you get these consolidations when nobody thinks there could be a consolidation, when they think there's a paradigm shift, it's different. This is often where they happen. So I drew a possible roadmap here of just like some type of flag, bullish, descending, expanding wedge, a probable roadmap. I don't know if it's going to play out like that. You'll have more certainty that the correction, right now we have a slightly, when the momentum, the distance from moving average, guys, let me just clean that up a little bit for you guys. Here, 1 touch, 2 touch, 3 touch. As soon as the distance from the moving average closes below that rising trend line, the probabilities that you're in a correction are 100% there. Like there's a much higher chance that you're in a correction, and it'll probably break that line before the price action loses a rising trend line. Or if you get a close below that rising trend line, also now you see that rising trend, the pull, it's done, the flag. So it's very embryonic. There's no low risk entries. We're getting close to entering a correction. You still have to lose momentum on this time frame, on the monthly time frame. You could you could zoom maybe on the daily time frame, weekly time frame to spot the turn. But on this time frame, the measured moves are reached. You're stretched, and now it's just a question of time to see when this thing will lose the rising support line here, lose the rising support line on the distance from moving average. And then the next low risk entry, guys, will be something like we had here in 2019, 2023. You want the price to consolidate, let that 3-year moving average catch up, and then you enter once it breaks out, and then you enjoy the next run, which could be gold all the way up to above 4,500, Kevin. Like goodness, this is the setup right now that's going to lead to much higher gold prices.
Yeah, and gold breaking out versus the stock market is critical to that as well, and that's taking place right now. So that does point to much higher gold prices. Yeah, demystifying those charts as always, Pat. Really good case study there of how the charts really, it's not any kind of voodoo. It's a case of really analysing the mathematics of it, and it's like a dashboard on a car, isn't it? Telling you when the engine is overheated, when you're at maximum capacity, when you're at max, however you want to, whatever analogy you want to use. It's a technical, scientific way of spotting those, as you say, low risk entry points. Brilliant as ever, Pat. And if you like that content and you want more, don't forget to like, subscribe, and hit the notification bell for more. Bye bye for now.